So welcome everyone. Thanks a lot for joining in today. I'm Giuseppe Basile, and today I'm going to be your host. I'm very excited for this new series, the continuation trading system for Forex and stocks. I'm going to start today a new series, and I will present a full-fledged trading system. So a number of objectives in presenting this material, and I'm going to show you what are the objectives. I want to thank Adinda and Vicky for setting up this webinar. So this is the agenda, very briefly, introduction and reasons why I'm doing this and why it's important, I believe. The description of the content and lessons, and then I'll start with lesson 1, in which I'm going to introduce the elements and the trading plan, and also explain the continuation style. I'll offer price examples on stocks, Forex, and futures on Forex, and then we will look at the next steps. You have also here a banner. This is about my Fibstalker Methods coaching program. If you are interested, you can take your scissors and take advantage of the opportunity on FX Trade, where we offer up to 24% of discount on monthly, on very small monthly fee. So, of course, risk, it's all about risk. Risk, as I'm going to show you also in this first lesson, is actually trader's job number 1. Past performance is not indicative of future results. I've also offer some charts and review charts, and before taking any action, you should understand the risk, and also you should understand really and test all the information you get from me and from anyone else. So a little bit about myself. I have a computer science engineering background in 1999, a master's in finance in 2010, and I was certified market technician in 2012. I'm an associate for the International Federation of Technical Analysts and published 3 papers in the last 3 years. I started in 2001, understood the importance of research in 2003, and also, most importantly, the importance of mentoring in 2006, and I worked with a number of mentors, including Van Tarp, Ivica Juracek, David Asley, to name a few. I have over 19 hours of, thousands hours of total market exposure at the end of 2015, and I've launched FibstalkerTrading.com, where I offer the Fibstalker Methods coaching program. I've also authored the Fibstalking timing technique, which is a proprietary technique that uses the presence of algorithms on small time frames in high volume modern markets. And if you're interested, I offer a weekly newsletter at Fibstalker.com. I've been involved in speaking, and I speak at large investment and trading forums and show. The last one has been the Money Show in Toronto. I'm also a premium contributor to FX Trade. Now, why Fibstalker? For those of you who know me, I'll be very quick here. Fib comes from Fibonacci. I don't use Fibonacci in a conventional way, but non-conventional way. And these are the only numbers I use: 50%, 61.8%. I use 123.6% and 161.8%. All the others, for me, they have a better explanation, and so I don't use them. The Stalker part, it's funny. I don't know how to stall people. I stall price, indeed using modeling price using Fibonacci on all time frames. That does not work for all markets, but only high volume markets. And in these high volume markets, where there is the opportunity to identify well in advance a level of potential reaction, when the price comes into that level of potential reaction, what I do, I study the sequence of measured move on the smaller time frame, and there is always a level, just one level. When the level is pierced, that's an indication that the market can actually get me a 1 unit of risk and gain, and that's all we need for, or I need at least, for trading. So let's get into the content of this week, and thank you for joining. So we have a journey into the definition of a valid and currently used system. And this is very exciting. It's a valid system that can be used on stocks, Forex, futures, and it helps solving the problems also in the context of profitability. And I'm going to speak a little bit about that because to be successful in trading, I believe there are two areas we have to master. One is profitability and the other is consistency. And for those who know me, or if you don't know this model, you can go back and look at the model for profitability and consistency. So profitability is about solving problems related to market, price distinction and the mechanics of price, while consistency requires that we take and master problems related mainly with our beliefs in the markets. Okay, so I'll show how to build and formalize a trading system that works. And this kind of works with and fits into the other activity I'm doing at the moment, which is presenting trading systems that work. Also, I address the importance of a trading plan. We all know what a trading plan is, or maybe not. Some people do not know all the elements that are needed in a trading plan. And I'll show you the elements that are needed in this specific trading system I'm going to share with you, and includes consideration of risk management and position sizing as well. It still amazes me how many people still do not perform proper risk management, and a lot of people do not know how to size the position. Indeed, 22% of retail trader, according to a statistic I got from OANDA last year, they don't even know how much they are risking. Actually, they're risking 100% of their capital, and they only figure that out when they get a margin call. So I'll present a system that is easier to relate to compared to other systems. For example, it might be difficult to relate to algorithms, effects of algorithms on price, but this system is very effective and very easy to relate to, and offers also and uses some patterns. I'll also give an explanation of those patterns using algorithms, why those patterns actually present in price. And later during this series, I will discuss the improvement based on my own research. So not only I'll give you a system, but I'll also show you how we can improve the system, working on some aspects of the entry and the stops to increase the expectancy of the system. I will provide figures on system profitability, reliability, and expectancy after the improvement, and we will talk about psychology and confidence, and give some example, personal, professional, and some students I have. So it's quite interesting and it's quite rich. So it's something you can actually use, and it's something that my objective is to help you form and reinforce the right beliefs about successful trading, but also give you something that you can use right away. So now this is reaching profitability and consistency in trading. I'm not going to explain this in detail. What I'll just say is that we're going to focus mainly on the mechanics here. I will offer also some elements on how to calculate statistic expectations. I will not talk about objective. And, I will mainly focus on this area, which is, how to generate profitability with a system. However, profitability and consistency with every system require way more than the mechanics of price. Okay, so it requires that we build the system, we test it, we create confidence, we tune the system, and then the upper part here we start actually minding the beliefs and the discipline and work on our mind. So This is a brief description of our exciting journey here. I will speak about the elements of trading plan and continuation style, explain what a continuation style is, I'll give basic chart patterns and statistics, talk about advanced patterns, justification of traditional patterns with algorithms, modeling, how all the patterns are connected with the different time frames as well. And then I'll explain clearly how you do risk management, position sizing, and on which time frames you're going to trade and how, and what to expect next in the market in order to take advantage of the opportunity that you're seeing. And then I'll discuss a little bit about personal experience of a few traders, and this is about trading confidence. And we'll also formalize the trading system for you. So you will have, at the end of this course, you will have a formalized trading system and the rules of the trading system. And then I will illustrate in the end how the system can be improved based on a research that I published in 2012. Okay, so I hope you find this interesting. I find this for sure interesting, and I believe there is a lot to learn in going through this process. So if you got any questions so far, please write them down. If you have questions, you can actually write them, and I will answer all the questions. So let's start right away. One important subject in trading is the trading plan, and some people, make fusion between the trading plan and the trading system. I'm going to clarify what those mean here. Now, no matter what you trade, Forex, futures, stocks, you need a trading plan. You must have trading plan which is clear and defined before market open. Now, you may laugh at me and say, but Giuseppe, what's the market open for Forex? And I can see the market open for Forex 5 p.m. EST, Sunday until Friday, and that's the market open. In stocks, much better defined, 10 a.m. New York time. Europe, it's 10 a.m. depending on the countries. So you should create a watch list of your stocks, Forex, futures on Forex, futures on before the market opens, and after that you just follow your plan. And a lot of people find this very, very difficult to abide to do, and we actually should. We actually should, on the other hand, remember that that's the only way to be successful. Okay, there are no other ways. You cannot be successful without a trading plan. And if you think you can, by being by not being systematic, being discretionary, and do one thing one time, another time a different thing, then I don't think it's easy to reach success in that way. So trading plan is not complicated, and includes a number of important info. What are these information? All the information you have to have clear in mind to take the trade. There are 6 main elements. It must be very, very clear to you well before you take the trade. What to trade, the direction, the entry level, the price, the stop loss, the profit taking, and the position sizing. How much do you put on in your position? Okay, very, very important. You might know some of these things, but I bet that a lot of people do not have that structure in mind. Indeed, I talk to people all the time, and the majority of them do discretionary trading. They do not, and most importantly, even when they have a very well-structured professional background, they do not apply structure to their trading. They believe they can actually trade in a discretionary way. So there are several parts for trading system, and if you're interested to that, you can actually review the. I'm moving here on FS Street and sharing this. You can actually. You should be able to see the page here. You can actually go to the list of webinars. If you're interested in understanding more how to run a trading system that works, this is very, very important information. You can go on have a street and watch the series Riding and Trading System that works. Okay, and so going back to the different parts of trading system, there are 10 different parts. We'll not focus on all of them. Again, there are archived webinars here you can look at. I will not focus on filters, re-entry, money management, portfolio selection, and multiple systems, although you can, of course, trade multiple systems. And now, some of these parts of a trading system define elements of a trading plan. So what that mean? When I was preparing this, I was looking around on the internet and found this. It was clear to me that men and women were equal, if not more so. So, sorry, Al, you're not helping. What do we mean when different parts of a trading system define a trading plan? So let's look at that. So market selection, identify the financial instrument. This can be a stock, Forex, futures on Forex, you name it. Market selection. Market direction is where we're going to trade. It's a long or it's a short. There are only two options here. You do directional trading. And the entry price is defined by the setup as well as by the entry and market timing. Stop price is defined by the protected stops part of the trading system, and profit taking by the exit or profit taking part. And finally, how much do you size your position is your position sizing. So on the left here, we have the parts of a trading system, and on the right, we have the parts of a trading plan. Okay, so there is a difference between the trading plan and the trading system. The trading system is the logic, the rules that define a specific trading plan. A specific trading plan is just a list of things that you need, 6 things you need. What you trade, long or short, what is the price where you enter, what is the price where the market is telling you that you're wrong, that's the stop, and profit taking and position sizing. Okay, profit taking is the level where you exit the market. Are you with me so far? Give me a yes if all this is clear. And it's very simple, obviously. But we will get into the more interesting stuff. So the market works in several ways. What I mean here is that it can be modeled in several ways. One of these is the continuation style, which is the focus of this set of presentations. The different traders model market in different ways. For example, in the past I used the continuation style. I still believe it's a very good system. Today, though, I'm a little bit more precise, and I actually use the effects of algorithms on high volume modern market, and that effects can be seen on all time frames. Now, regardless of what you trade, there is always a fundamental behavior of the market, okay? And this is called the move, rest, move sequence. How many of you have heard about this before? Give me a yes if you have heard this. Give me a no if you have not heard about this. Please go ahead. And what is the move, rest, move sequence? Well, it's very simple. There is a price consolidation that happens after a first move, okay? And basically, this is the reason why the system is called continuation system or continuation style. While there is a first move that can be up or down, and then the market, it can be very steep, more or less steep, then the market consolidates and the market continues. So continuation system, that's a basic fundamental behavior of the market. And if you know me, you know that I only trade and study fundamental behavior that are grounded in the way the market works. And that's what you should do as well. Very often you will see a move broken in 3 phases. A first initial move, as I mentioned before, a price, a consolidation of price rests, and then a new move in the direction of the first initial move. Okay, nothing really new here, but this basic market, fundamental market behavior can be used very, very profitably to actually generate setup and generate gains. Now, so there's a new way of thinking here, thinking of identifying a structure in the market. This may be a new way of thinking for some of you. Some of you might know about it. Some of you might have imagined that or seen that on charts, and maybe don't have a way to leverage that and take consistently and regularly advantage of that. For some other of you, this is a new concept, so it's important to have that structure in mind as well. So think like that, and a good portion of price will also make sense to you, because in the end, price is just price, just data series, and we have to get a structure in that data series. So a simple way, an effective way of finding structure in the market. And let me give you a simple example here. We have in this example, we have a move higher, which is targeted by number of ones here, and then this is the consolidation. Okay, this is the next step, which is this area of consolidation here, which is tagged with two, and then there is a continuation higher here. And there is one concept we can use, which is the Apple move concept. So we measure from the start of the move to the end, and when then we witness all this, so there's no action until we have some ways to decide where the market may start its continuation higher. Okay, so all this area here is just observing price, and I'll get more into that later on. Okay, so let's look at an example on Forex on two different time frames. This is a daily, and this is now an identification, very, very high level and very, very quality. Okay, I'll become very, very quantitative. Move higher, rest, move higher. Move lower, rest, move lower. So, and again, if you go on the weekly, you can say all this is also a move lower, and there is a reaction and move lower. So this concept works on multiple time frames as well. Again, I'm just showing this to you in a very qualitative way. We will become very quantitative. Move higher, rest, move higher. Move lower, rest, move lower, and so on. Now, very quantitative, but as you can see, this is a basic behavior of the market. And most recently, I'll show you also example, a smaller time frame, move lower, rest, move lower, and that's how the market is moving at the moment. Okay, so recent examples on the 4 hour, on the 40 minutes, and in the last few days we had a few of them. Move lower, consolidation. This is a base here, move lower, and again, move lower, consolidation, move lower, and again, we have move lowers, consolidation, move lower here. Okay, now it's easy to identify after the fact. I'll show you how to identify this before the fact to trade it. So let's study price behavior. Let's elaborate on these different phases of price behavior. I showed you there are 3 different phases. What the rest phase is giving us? Any answer, any idea what the rest phase is giving us? Write it down if you have any idea. What it's giving us is a net change in previous price market character, because before the market was moving lower, for example, in those examples, very briskly, and then it stops moving lower for some reasons, which I'm going to explain later, and then it gets ready to continue a move lower. That doesn't mean that move comes all the time. Sometimes it's just a reversal. But when it comes, if we manage risk properly, we can take advantage of that behavior. So Mr. Market is presenting us with a low risk opportunity. That's why consolidation are important to us. With other rest phase in price behavior, we could not trade low risk opportunity. And this is true also for other systems as well. For example, in my system, I look at 50% retraces, and I wait for the market to get into those levels. And if that's the same concept, it's a low risk opportunity, and in this case, in my model and the way I trade, all this is a rest. It's a consolidation before we get into the 50% level. Okay. By the way, I'll mix elements of my later in the course elements of my trading model with this system. So risk management is trader's job number 1 before thinking of gains, because it's about low risk opportunity. It's all about risk. It's not about gains. Gains, they come only later. periods of rest in price create price patterns in the smaller time frames as well. And they are well-known TA patterns, so we leverage those patterns as well. Examples can be triangle, flag, space, pennants, and so on. We only use triangles, flags, and bases in this system, and so you don't have to be a TA expert in order to use the system. In lesson 2, I will also give some statistics and reliability of some of these patterns. Okay, so be tuned and be back in lesson 2. All right, so price, rest, and the relation with setup and entry. There's a relation with this rest and consolidation phase we observe in price and the setups that I'm going to give you for the continuation trading system. Okay, and these setups actually of the continuation trading system offer what? They offer. Let me see if I'm showing this properly here. Can you see the screen? By the way, can you give me a yes if you can see the screen? Just making a check here. Please, can you give me a yes if you see the screen? Not sure whether it's there. Okay. Okay, the setup of the continuation trading systems offers what? A timing mechanism, the rules, and a way to identify the entry price. And we need the price rest phase for this. So we need the rest also to time. Without that, we cannot time, basically, because we cannot identify a pattern on the lower time frame. We take advantage of the existence of such behavior, the consolidation phase. And you may ask, okay, but where the consolidation is coming from? Why price? This is you say this is a fundamental way the price moves. Why? Where this is coming from? So this is coming from profit taking from the previous move. If you had a move lower, now there is profit taking. So this generates this consolidation. Okay, and this is one of the major reasons why we get this consolidation. But there is more algorithms running price in opposite direction on the smaller time frame, because algorithms in modern market are present with an overwhelming volume, more than 80% in some markets. So we know they are there on the smaller time frames as well, and they are there trading against each other on different time frames. Reactions on the smaller time frames, sometimes the smaller time frames is in control for a very short period of time, noise or news, and just a reversal. Sometimes we see that move that is the start of a reversal, okay, or a consolidation before the reversal. So price rest becomes the area to initiate a trade. We analyze the price consolidation area to decide how to enter the market. And this is going to be very, very specific, very deterministic, very procedural. There's no space for discretion, at least in the way I look at trading. Typically, analysis requires drill down into the lower time frames, and we do this all the time, to identify a low-risk entry point, the first element of a good trading plan. So low-risk, entry point, these are key words. We need an entry point with a low risk to define a good trading plan, and in this case, where that could be. So we observe this triangle here, this consolidation in price, okay, and we're observing this on the same time frame. This is a daily where we identify the opportunity, okay. Mind though that when we are going to trade, we're going to identify the entry on a time frame below. We drill down one time frame, so for example from daily to 1 hour, or even lower to 15 minutes. Okay, so we always drill down because we want to get an opportunity to get a better reward to risk. Okay, so now in this specific case, let's say that we stay on this time frame. Where could be a level where we enter? A level could be, for example, it could be a high in this consolidation as the market is actually, as the triangle here is closing. Okay, now I see it here just above $29. Now, what does that mean? It's just above. It's not deterministic. Just above could be, 50 cents above, 10 cents above. This is a stock, okay? And I also showed volume here. I'll talk about volume later on. But let's look at this. We could actually decide to enter just above 29. Why 29? Because that's the high of this latest, of the last few bars here tagged with 2. And 2 is consolidation. So 1 is move higher, 2 is consolidation, 3 is continuation higher. Okay. Now let's look at this. So what that means, what just above is, how much above is just above. So previous precision determination and quantification is the name of this game. Always, I always repeat that. I believe strongly. And if you're planning to win using discretion at this stage, good luck. It's not going to happen. Sorry, we have the numbers to back that up. 95% of traders lose money in the market. I've proven this formally because I like to offer proof. I've proven this formally in the series, how to get and stay in the elite. Okay, so review this. If you have not done that, I show you formally how and why 95% of people do lose money in the market. So if you want to use discretion, good luck. The probability that you're going to get into that 95% is very, very high. So I do not recommend and suggest you do that. So now just above here, what that means, well, we have to be very, very precise. That's called the overrun, how higher above the entry level we want to see price before we get involved. It's kind of a confirmation. And for Forex, 3 to 5 pips. For high price stocks, more than $20, use 10 cents. And I use 5 cents for price below $20, okay? So this is how above, it's just above, okay? This is the confirmation. Now, there is nothing magic about these numbers, and you have to know that. So you will get a confirmation, then price go against you, which to me often means that you didn't enter at the right point. Now, when it comes to entering at these consolidations, very often the right point or the most logical point to enter is very well defined. Again, these numbers do not guarantee, because nothing is guaranteed in the market, that you will get an entry and will not be stopped out. So we need a way to trigger. That's why we need these numbers. We need a reasonable overrun or confirmation above, over and above for longs and below for shorts. The entry levels we identify, and of course that level has to be compared to price. So that's why for high price stocks we have a different different overrun there, and they work just right. But as always, you have to test them. Okay, so setting stop losses or simply stops. This is very important as well. I would say this is the first and most important element of plan. And overall trading, because now that my strongest belief is that risk is trader's job number one. It's not gains, it's not generating gains, it's not even identifying setups. It's all about managing risks. Best setups comes where the risk is the lowest. And there are ways to identify that risk, okay? And I'm going to show you in this trading system as well. Where do we put our stop? Assuming, of course, how much you're risking, because as I mentioned before, 22%, at least 22% of traders do not know how much you're risking. They're taking position based on position size, and they don't know what's the percentage they are risking. So let's reason again on this. Where could we put our stop? Well, an ideal place could be below the lows here in this consolidation, because we see kind of price kind of following and printing in higher lows here. So One idea could be, let's get the lower price so far in this consolidation and let's use those as stops. Okay, so this is not a rule. So where do we put it then? Again, after the leftmost bars target with 2. Why? Because the idea here is that any additional noise or residual variability that can come from price during the remaining of the development of the consolidation, because remember, we are still in the consolidation here. We are preparing our plan. Let's say that we are here. Okay, so this level has been printed already. We are still within the consolidation. The consolidation is still developing here. We have not taken any decision yet on what is going to be our entry level. But as the market develops here, we also develop an idea about that. And so why we do this? Because we believe that the additional noise that can come during the residual development of the consolidation, that variability, it's actually supposed to be absorbed by the distance between low and high. Okay, so again, the idea here is that the variability that I can get here, it's absorbed by what? By the distance between the highs and lows that has been printed so far. Okay, so that's a basic assumption. Is this a rule? Let's talk about this. Is this a rule? No. At this stage, it is just a hope. Okay, and for it to become a rule, we need to measure. And you have to measure everything. You have to test and measure everything. Okay? So, do you realize then that just putting some lines, trend lines around this price to model it does not create a rule on what price behavior should be? Very, very important. It's not a rule, it's a hope. And I'm jokingly say that we will later on in the process and during the presentation of this material, we will convert a hope back to being a rule and something that we can use and we can actually measure and we can use in our trading. Okay, so let's continue. Very, very important. Realize that this is just a hope, is not a rule, and we need to have rules for trading. This whole idea of hopefully reducing variability is the answer, and we can expect the move after the consolidation to be larger than the height of the consolidation. Okay. Again, let me repeat this. We can expect the move after the consolidation to be larger than the consolidation. So what I'm saying here is that we observe this. Now, this is the height of the consolidation, okay? If you want to take it in full. Now, what I'm saying here is that the move here that ensues, number 3, that comes after the consolidation is higher and it's wider than the consolidation itself. Indeed, there is this difference here, as you can see. Okay, that's what I'm trying to say here. And so far, all of this is qualitative. We will bring this into quantitative realm so that we can actually use that and measure the edge we get. To enable test, of course, this seems to be true, as I showed you in the previous example. However, we have to enforce that with risk reduction as well as risk management. More on this later on. The direct correlation between the height of the consolidation move and the risk must be managed in the trade. It's all about risk management. And so you should always ask yourself, how am I managing the risk in this trade? Always about risk. I mean, how each trade offers an opportunity. How are you managing the risk in that opportunity? Okay, it's all about how you manage the risk. Let's look at an example to see how variability may be reduced as the consolidation develops. Okay, so I'm going to show you granite constructions here back in 2008, and then I'm going to show you most recent examples. We have the move lower here, and then we have our consolidation, and you might you might trace a trend line here immediately after these 2 points, so you can wait. Of course, the more you wait, the more the possibility that the continuation comes in before you get a break. Okay, so that's something we will discuss that. Of course, at this stage, we're still in a quantitative realm. So we have a triangle here and then a continuation low, okay? Now, when we look at the 15 minutes, on the 15 minutes, you can do other things as well. This is the consolidation in the bolder here. This is the consolidation on the 60 minutes, but then once you are here, you can start observing that there are aggressive lines that you can trace also on the smaller time, and that's just for your thought. Let's look at an example on the 60 minutes and 15 minutes for euro dollar, very recent, November 2015. Same situation here, of course, at this stage, very qualitative, so you can say, well, here I could identify this trend line here, so, very much more aggressive triangle. This is not a triangle, indeed, this is a pennant. And if you waited, you had anyway another line here. This was still profitable. And in these ideas, we put the stop. In this case, you would put actually the entry level here or here, and the stop will always be above the highs. And in the second trace here, you would probably put your entry at this level here, and your stop at this level here. Later on in the course, I'm going to show you how we can actually improve reward to risk by reducing this distance here. Okay, and so the idea is this one. We actually model the price consolidation, and then we use that model to enter, and also we use the previous move here, and we measure and we take profits at an equal move. That's in a nutshell how the market works. On the 15 minutes, that's what we see. So you could actually say my entry is going to be for this aggressive trade here. So I will only enter when price gets 3 to 5 pips below this level, and my stop could actually be here. Okay, so that's the main idea. If the consolidation is there, and it's this is the way we reduce the risk on our trading. Okay, and in this case, you could have 10.0880, let's say 75 entry with a stop at 95 here. Okay, so as you can see, this is a 20 pips stop, and 20 pips is not really a lot. Okay, and in these 20 pips, of course, you want to risk what? A fixed percentage of your account. So that's money management. If you don't know these rules, I'm going to give you these rules as well during this course. Consideration on volume. Now, in some markets where volume is available, volume can be used as an indication of commitment. We know that very well. That's one of the simple things we learn when we start learning about trading and tech analysis. That does not work on all markets, though. Forex, for example, has no reported volume. It's not a centralized, controlled market. It's a decentralized market. But yet there are ways to get volumes on Forex in different ways, for example, by looking at futures on Forex. And we will see an example of that. So when we look at volume here, and again, this is granite constructions, there is the move lower here. And associated to this move lower, there is a volume here that decreases. Now, interesting enough, look at this, during this consolidation, the volume also decreases. It means that there is no interest in reversing this price if we see volume reducing here. And then when the next measure move picks up, we have an increase in volume, which is something that, on the other hand, we want to see when the market is continuing. So this is a typical behavior of of volume. There is consistent volume in the first move. There is then a reducing volume during the consolidation. Then the volume picks up again in the continuation. Okay, so that's very, very typical. So compared to volume in moves 1 and 3, the consolidation goes on relatively a lower volume here. So on the first move, in this specific case example that I just showed you, the volume is higher and then diminishes. On the rest move, a consolidation move, the volume is lower and diminishes. And on the third move, the volume is higher and increases, and this is the textbook. This is what we would like to see. Of course, that's not always what we see. And the lower volume on consolidation suggests profit taking and not new potential long position being opened. So that's the meaning of lower volume and lowering and diminishing volume on the rest part. Okay, so let's look at an example of the euro currency, the CME big euro contract, futures euro contract here on the 16 minutes, and we will see the same patterns. So this is a recent chart, November 4th, 2015, and we see this first move lower, and then the consolidation starts here, okay? And you could say the consolidation starts here or it starts here. I mean, it doesn't really matter. It's a consolidation for a previous move lower, so we need to have some ways to model price, but that's not important. Now let's focus. Sorry, that's important, but that's not what I want to focus on. Let's focus on volume here, which is reported on the futures EC European currency CME big future contract. As you can see here, during the consolidation, again, we had this pattern of lower volume, and then there are spikes here, which is interesting. It's always interesting to see a market that spikes in a continuation. Okay, same thing here, 60 minutes. This is November 6th to 8th. Very, very recent here. Again, we had the same pattern, the move lower, the consolidation. In the move lower, we get this spike, which indicates participation. And then we have this pattern here with price getting into lower and lower volume before the move. And of course, you know, we see all these Asian sessions here with very, very limited volume. So that's not very relevant and important. The volume will always be low during that session, comparatively to US and European sessions, of course, okay? Now, let's talk a little bit about price page. I don't know if you ever heard about this concept. This is a very, very important concept. And it's something that we can use and we should be using. So qualitative and quantitative concept, what is this? Qualitative and quantitative concept to measure steepness in price. Okay, so we saw steep price before the consolidation, then the consolidation, and then again steep price moving lower. So and the point here is that it took 13 bars for price to go from highs to lows, and it took more than 25 bars for an equal move of $5 here to continue. So when we have to establish whether the first move was steeper than the other, actually the steepness here, it's almost, you know, based on this quantitative measuring, it's almost double. Very steep, half steepness. Okay. Now, the pace or steepness, it's important because it gives us an idea of commitment of traders. When we see this very, very high steep move, which moves $5 in 13 parts, and this could be a measure of how steep the market is. And the lower this number, which means the faster this move is printed. Okay, so if you want to have a measurement of the steepness, you could do 1 on 513, or if you wish, the number of bars divided by the number of pips or dollar move. Okay, and I would then call this the number of pips or dollar here. Okay, this is a measure of steepness. The higher this number, the steeper is price. Okay, so in this other case, we have then 25 on 5. That would be a measure of how steep. Okay, and again, you can reverse this ratio if you want to get the highest or the lowest number. So the highest steepness is actually is saying when I divide 5 by 13, this is giving me this is giving me less than it's giving me 13. Is giving 1/3 is giving 0.20, a little bit more than 20, and here on the other hand is going to give me 0.20. Okay, so this is a measure of quantitative measure of price space as well. Why price space is important? Again, in this example, we showed 13 1-hour bars for the first move before the rest and 25 for the second move. When price prints big, long bars in a small amount of time, that means commitment. It's a sign of commitment. And again, this is not a rule. This is a hope. And before this becomes a rule, we need to measure. We need to measure and test our trading edge to make that a rule. Okay, why is that an hope? Because price can do anything, and if you have not realized that this is a basic principle, respectful principle, and I integrated this principle, which I got from Mark Douglas' Trading is in the Zone, into my trading, and you should do the same as well. That's very, very important. The corollary of this is that risk management is treated as job number 1. Okay, and again, this why we need that, because price can actually do whatever it wants, and you have to be ready for any outcome of price. So when price prints big, long bar in a small amount of time, it means that price space is very high, and this implies commitment from traders towards the current direction of price. Okay, and on the other hand, if bars are comparatively smaller, or price simply takes a higher number of bars, as we showed before, compared to previous similar moves, then it means that to cover the same distance, it means that the price space is lower. And we can also see this visually on chart price moves. Now, sometimes that will not be evident, so I gave you the formula to calculate the price steepness, so you can actually quantitatively say, yes, it is more steeper than before, or less steeper than before of this amount. And that's always very, very important, because I like to measure everything. In a healthy measured move, after the rest phase, we want to see price pace increasing compared to pace in the previous move. And it's not always the case. And even when that does not happen, does not mean that the trade can be successful. In fact, very often, the pace in the second move is less, as I showed you in the example before, is lower than the pace in the previous move. Now, that's the textbooks, the real trading with or without volume, because volume might be low during the first or the continuation move, or volume might not be there at all if you trade Forex, and volume could also show spikes, as I showed you before in the futures on Forex, high readings on some bars, even during the rest consolidation period. So Now, this in general, if the volume has spikes, generally does not invalidate the setups if the price stays generally below the 50 bar volume average. And this is a filter you can use on volume as well. Most importantly, we have to consider the benefit. And what is the most important benefit? It's to price, to help us find a good price consolidation patterns. That's the value of the system. And we know that these price consolidation patterns can quietly lead price into future continuation moves. That's the value, and that's what we want to achieve here. So this is why the method is called a continuation style, because it leverages price continuation with focus on this fundamental behavior of the market, which is move, rest, move, action. Okay. Any questions so far? I will continue. So how do we beat Mr. Market? And I'll put this question on you. And we want to, get an answer here. We have Tarmo, Lehong, Adinda. How would you beat the market? Any ideas? Write it down. How do we beat the market? Any ideas? Okay, so if you have no ideas, I'll tell you some ideas. Without good continuation patterns, as I mentioned before, it's more difficult to get a good risk-reward of a trade. And it's a hardly successful way to trade. And again, I showed you before, go and review the series, how to get into and stay into the elite 5%, because I explained there why and how it is possible to that the majority of people lose money in the market. We will describe good continuation patterns in the next lesson number 2. And you know that risk management for me now is trade job as number 1. It should be for you as well. I strongly recommend that. And for setups, we need to define portion of the plan. Okay, and the portion of the plan tells us when to act, how to time and entry the market, while we put the stop loss. And I will show you different elements, including averages, resistance, support areas, as well as price itself, to help identify where to put stops. But when we do really beat the market, when we do that, well, we beat the market when we consistently take profits out of the market. And I would say when we take profits out of the market. And of course, you want to do that in a consistent way. Okay, so this is when we beat the market. If we're not able to identify where we take profits out, we are not going to beat the market. Okay, that's the only way to do it. So, and remember that we are only solving the profitability side of things here. In order to get consistent, we have to work on our beliefs, discipline, testing the system, and working on execution as well. So partial exit, then and risk management. Partials are not strictly required by the trading plan. However, I always have beginners and experienced traders and myself using a partial profit exit for risk reduction and control. Okay, so that's the way you should always trade, by taking partials. And this limits the removable losses that you're going to face when you start trading any system, especially if you don't test the system properly. Okay, and but it's also a fundamental part of my risk management. In fact, there are several ways of using partial, but there is one I prefer, which is exiting 50% of the position when my current paper gain equals the amount at risk. Okay, and some people might not like this. They say, well, but if I exit 50% of the position and then the price moves much higher, much lower, then I lose on gains. Who cares? It's all about risk management. It's not about gains. If you do risk management, you generate a higher number of opportunities, and you actually manage risk in the proper way, so that when you are wrong, or the market reverses on you, you exit just at a break-even plus cost of trading. That's the way to trade. That's the way to generate consistent results. About risk management, generating consistent results is not about the next big trade. That means that pip or tick and dollar gains equals the pip ticks risked. Okay, for example, if your stop is 35 cents away from your entry, then when price is 35 cents above entry or 70 cents above stop, you can take a partial profit. So you take 50% off. Okay, I think you should do this consistently. I do this consistently, and that's when you are really doing risk management. And I call this risk reduction as well. In the following, I will refer this to pip tick or dollar amount as 1 unit of risk, or 1R. 1R is my 1 unit of risk. So in the future, we'll talk about this. Okay. So this is it for the first lesson. I hope you enjoyed this first part. If you want to continue following this series, you just have to go on FS Street and keep following the series. If you want to reach me, you can find me on fibstalkertrading.com, and if you're interested in method for repeated success, then this is what I suggest, and there is a great offer going on at the moment on the coaching program with monthly fees. This is it. Thank you very much. If there are questions, and we still have time, we can go through questions. And the next steps will be starting with lessons 2 and looking at the patterns that we use in the smaller time frame to identify opportunities. If there are any questions, I'm going to answer questions, or otherwise I will see you in the next webinar. And remember, there is also the other series I'm running at the moment, trading system that work. So if you're interested, let's look at that. I have a question here: how to avoid false breakouts? Is very good questions. Well, there are a number of ways to do that. First of all, we have the confirmation levels that are above the entry levels, and also we look at the patterns in the smaller time frame, how they are formed. Plus, in the last part of this series, I'm gonna, as I told before, offer elements to improve the system, and I'm gonna push in the measure moves of algos and show you that sometimes you can reduce the stop. And I will also show some of this behavior when the market actually breaks and then retraces right away. And sometimes if we put the stop below the formation of, in the smaller time frame, let's say, if we put the stop below, so let's make an example here. That's a very good question, Tarmo. So let me show this on an actual example, at least a schematic here. So let's suppose that market moves lower and then there is a consolidation, and in this consolidation we identify, let's say we identify a triangle like this. Okay. Now, what I noticed that, and that's something I'm gonna talk about in the last part of this method. So sometimes I notice that the market actually breaks, right? It breaks the level and then it retraces. And this is not very good example. So let me use this. Okay. So the market breaks and then retraces. And the point is that if we use any of the stops that are suggested by the patterns, by the trend lines that define the patterns, we get stopped out. So in the last part, I'll show that research that I published in 2012, in which I addressed exactly this problem. So the problem is solved by moving, by defining the stop in a different ways that gets into account these problems. So let me show it in a more. I don't have a chart example, but actual chart example, but I will. It's already included in some of the lessons. So what happens is that, when we have this behavior here, and naturally we want to put the stop here, the market will do something different. The market sometimes, not all the times, because sometimes it just moves slower, but it will give a false breakout and then stop this level and then continue. So if it's a reversal, it will stop that level and just continue higher, okay? Now, if we define stop in a different way, I noticed that when that happens, it's possible to stay in the position, okay? So I'm going to show you. So there is no way to avoid false breakout, but there are ways to define stops in a way that if that happens, you're basically still in the trade. Okay, so I hope that that answers your question. So why algorithm run the price in the opposite during a consolidation? Well, I would suggest you review some of my webinars, but basically, when a price moves, it's a good question. When a price moves lower, let's say in a time frame T, we see the price moving lower. Okay. Algos, they have always targets, and if you study my material, you will see that there are different targets. When these targets are reached, the participation in time frame T, it's no longer so price is no longer pushed in time frame T by algorithms that are working on that time frame. So algorithms in the smaller time frame can actually pick up price. Okay, and the smaller time frame is T minus 1. So if the algos in T are not interested in pushing this price lower, it's easier for algorithms that are working on T on the smaller time frame to push this price higher. And that's the reason that we see this consolidation. Okay. And if price is not being pushed, if there is no interest in price to be pushed in the larger time frame, smaller time frame can take over, and they actually prepare the field for the next measure move in the larger time frame as well. Okay, they push price higher and they allow the algos in the larger time frame to get into the trade in the next measure move. So if you review my material, I talk about this. Okay. Any other questions? Otherwise, I'll close it here. Thanks, Tarmo, for your questions. Very appreciated. If you have any other questions, this is, of course, a quick answer, okay? But it gives you the idea of why. And actually, I talk a lot about algos, and if you want to review my work on this, please go on FX Street. And there are, in 2014, I talked about traditional and new uses of Fibonacci, how I use Fibonacci in new ways to model price of algos. And, you can review some of the presentation where I use algorithms to describe what's going to happen next. And you can also watch July 21st, the plunge protection team and the coming US stock market crash, in which I anticipated where the price would stop and where it stopped in August. And so that gives you an idea of how I use algos. How I use Fibonacci to model algos. Okay, thank you very much, Dan, and have a great day, and hope to see you I hope to see you next for the continuation of this series. Thank you very much. Bye bye now.